Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be the Wednesday, the 24th of July, 2024. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so now let's have a recap what has taken shape yesterday in terms of the news flow, events, and as well as their impact on their respective key cross asset classes price movement from a short-term basis before we jump into the short-term intraday technical outlook. All right, so yesterday's major event was actually more focused on the US stock market, which was the US market close. At the closure of yesterday US market, we do have two mega cap stocks that has released their Q2 earnings, which was Tesla and Alphabet, pardon me, a bit of time to think, Alphabet, which is Google. So now let's have a quick look on their earnings results. So what we could see over here is that Tesla disappoint. It reported a 7% drop in auto revenue, and the earnings fall short of Wall Street estimate. And Tesla shares actually dropped more than 8% in the after hours. So that actually we do see a gap down at the start of today's Asia session for the S&P 500 and as well as the Nasdaq 100 CFD index. All right, over here. And also Alphabet managed to beat expectation over here. So they made expectation, but however, if you look at their segment of their business unit, YouTube ad revenue, which is one of their business unit, misses on expectation. All right, so overall, we do see a good earnings number for Alphabet, i.e. Google, but however, one of their business segment, which is YouTube segment, their revenue actually misses the analyst expectation. So what we could see over here is in the after hours trading, they're actually down by 4%. All right, down by 4%. So net overall, we do see a gap down in the Nasdaq 100 and the S&P 500 we call it CFD index, which actually track the E-mini futures. So later I'll share with you all, despite this gap down on the Nasdaq 100, it's still holding above several key technical element that is acting as a support level or support zone, where later I will cover in much more detail in our intraday technical outlook segment. All right, so hold your guns first. All right, so now let's now focus on other economic data release. So other economic data release this morning, and in fact today is the our day of PMI data releases. So you know that PMI data is actually purchasers manager, we call it index, which is a survey being compiled by the S&P 500 make it company. They actually surveyed we call it a slew of company regarding about their business outlook, but on a manufacturing perspective and from a services industry perspective as well. So today will be the release of across the globe, I mean from different region, for the July flash data. So first, for this morning, we do see the release of Japan flash manufacturing PMI and services PMI. All right, over here. So what's interesting over here in the Japan flash PMI, we do see a very strong number on the services side. And don't forget, close to about 60% of Japan growth in the last 3 to 4 years has been driven by the services sector as well, rather than the manufacturing. So for the services PMI, it managed to actually roll back to expansionary phase. Previously, it was contracted slightly in the month of June at 49.4. So if you look at the trend of the flash PMI data over here, so there was actually a big bump up okay, to 53.9 from 49.4 in June. So this one could be a potential outlier. All right, if you look at the previous 12-month trend. All right, so if you look at the 5-year trend, very clearly it's still in a expansionary mode after this big bump up that was being seen in the flash data for July at 53.9. All right, so it was the sixth time of increase in the services sector so far this year, and the steepest pace since April. So very clearly it's trading in a series of very clear major uptrend phase in terms of services growth in Japan, which is positive for the Japanese economy, given that the fact that this in this Japan economy is about close to 60% that's driven by the services industry. But however, if you look at the manufacturing sector point of view over here in Japan, it continues to actually languish. This year, not this year, this month, for the month of July, the flash data show it slipped back to a contractionary mode again to 49.2, below 50 that was printed in June, and also below the market expectation or the analyst median expectation at 50.5. So if you look at the trend of the Japan manufacturing PMI based on the last 1 year, so initially it continued to expand since March. Then thereafter, for June and July, it starts to slip down. So overall, if you look at the 5-year trend, it seems to be in a sideways range configuration, all right, for the manufacturing industry in Japan. But then that overall market still view this as rather positive for the Japanese economy, and that actually also drive up the yen. So the yen strengthened pretty steeply against the dollar. But for those who actually follow our daily dose of market insights from a technical perspective and from an intermarket perspective, because of the yield premium between the US Treasury yield and the JGB yield has started to shrink since April this year. So that shows supportive of the yen rally against the dollar that has taken shape since start of this week. So if you look at the what do I mean by this? If you look at the current, yeah, this is the 5-day rolling performance of the dollar against other major currencies. So what we could see over here is that there is a big K shape that's being formed. At the bottom of the chart, we see the dollar performing the worst against the yen, and now it's continuing to sell off as well. So like I explained earlier, those who actually follow our daily dose of market insights since late last Friday, the dollar yen in fact is at an inflection level 157 60-70, which is the 50-day moving average that's acting as a resistance level, and right now it's clearly taken out the previous minor swing low of 156 figure level. Okay, now trading at 155.18. So later I'll share with you what are the key levels to look out for in this ongoing minor short-term downtrend phase of the dollar yen. So in fact, today's Japanese data for the services PMI data that is much more strong came in, that is better than expectation, and it continues its major growth trend, further reinforce this dollar yen weakness. That means i.e. yen strength against the dollar. Okay, but what's interesting over here is that the dollar continues to strengthen against the Kiwi and against the Aussie dollar, and kind of sideways against the other major currency. Okay, so this is what has taken shape so far this morning, and the impact on the we call it major respective major cross asset classes. So before we jump into the intermarket dynamics, I want to share with you what happened has taken shape last night over at the S&P. So what we could see over here is that the S&P and the Nasdaq, both of them actually fell down yesterday after a very strong rally that was seen on Monday, where actually both of them rose more than 1% each. So it's more like a bit of a profit taking. So the worst hit was actually the Nasdaq 100, negative 0.35%. That actually came before the earnings release of Tesla and Alphabet, i.e. Google, because Tesla and Alphabet, they released their earning only after the close of the US session. That means i.e. after 4 a.m. Singapore time today. And what's interesting over here is that the Dow Jones and the Russell 2000, especially the Russell 2000, continues to actually outperform the Nasdaq 100 and the S&P 500. All right, so the Dow Jones down by negative 0.14%, which is a smaller magnitude as compared to the Nasdaq 100, and almost on par with the S&P 500. But the biggest outlier, which is in a positive February was the Russell 2000, up by 1%. So close. If you look at the current year-to-date year-to-month performance of the Russell 2000, is actually up by 9% year-to-date. So what we could see over here is that compared to the S&P 500, it's clearly outperformed. So the reason of its outperformance over here is actually due to this ongoing intermarket dynamics that I'll share with you. So it's actually due to the bull steepening of the US Treasury yield curve. Okay, what do I mean by that? So very quickly right now, let's us go to the intermarket dynamics over here. So if you look at the 10-year US Treasury yield, okay, so this is the 10-year US Treasury yield over here. So this 10-year US Treasury yield continues to kind of trade sideways. Okay, it inched up slightly higher yesterday by around or even less than 1 basis point, almost half a 1 basis point yesterday. So it's kind of continues to actually inch slightly higher, but still trading below the 20-day, the 200-day, and the 50-day moving average that is acting as a near-term resistance at 4.28, 4.32%. But however, the 2-year Treasury yield, it is the 10-year, the 2-year, let me go all the way down, yeah, this year. This 2-year Treasury yield starts to actually shape a bearish reaction in the last 2 days, very clearly, after this spinning top that was printed on Monday, Tuesday and Wednesday right now during the Japan session is actually inching downwards and printing another new lower high. Okay, so what I could see over here is that the 2-year is now having a much more a deeper magnitude towards the downside compared to the 10-year. Okay, so this actually causes the 10-year, the difference between the 10-year and the 2-year to actually steepen. Okay, when this steepening effect takes shape, it actually will benefit to value-oriented stocks, not technology or value-oriented stocks, which is heavily weighted in the Dow Jones Industrial Average, and also it will benefit stocks that have a lot of debt that's being tied to short-term interest rate, which is the Russell 2000, because the Russell 2000 component stocks, they tend to have a lower credit ratings compared to the bigger boys, like those that are listed, those component stocks that are in the S&P 500, the Nasdaq 100, or even the Dow Jones. So these smaller cap boys, so we call the Russell 2000 a small cap index. So this small cap index, because of their lower credit rating, they cannot negotiate better credit terms and with longer credit terms in terms of the duration of their debt. Why? Because lenders will not want to borrow them in the longer term because of their lower credit risk standing, just in case they can't pay up or they actually defaulted some portion of their debt. So most of their debt holdings in their balance sheet are shorter term in nature. So given shorter term in nature, they are the interest rate burden is being tied to the lower end of the US Treasury yield curve. That means, i.e., the 2-year Treasury yield instead. So given the 2-year Treasury yield is coming down lower and lower due to this impact that I shared with you earlier on, there's a lower high, and this low high is formed right below the descending, we call it declining 20-day moving average, indicating to us that this ongoing medium-term downtrend since the bearish breakdown on 13th of June this year over here continues to remain intact. All right, so it means that right now the Russell 2000 companies are able to refinance their shorter term debt with lower interest rate coupon or expense. So it actually reduce their debt burden, their debt servicing burden, which could potentially improve their net margin. All right, so then the fundamental reason why the 2-year Treasury yield is falling at a faster rate than the 10-year Treasury yield, because the 2-year US Treasury yield is linked to monetary policy, which is the US Federal Reserve Fed funds rate. And we know that at this juncture, at this point in time, more or less, market has been kind of firm up that we are looking for the first interest rate cut to come in the September meeting by looking at this CME Fed Watch 2 over here. So despite there is this ongoing, we call it a volatility in the political calendar in US, the market expectation for the stance of the US Federal Reserve due to the latest economic data releases out from US in a 1.5 weeks, still are in favor of looking for the first interest rate cut to come in September. All right, as compiled by the CME Fed Watch tool, which is on your screen over here right now. So let me expand the screen so that you guys could see much clearer. So let us go down to the aggregate meeting probabilities. So currently right now, the Fed funds rate is at 5.25% to 5.5%. So at the end of this month, on the 31st of July, there will be another FOMC meeting, but this July meeting, there will be no cut or no hike. So market is looking at 97% chance to stamp pat. But what's interesting over here is that more than close to 100%, at 98%, market expecting is a cut to come in the September meeting, which is the 18th of September over here, to bring down the Fed funds rate from 5.25% to 5.5% to 5.25%. So there is a 25 basis point cut. Then thereafter, it should start to see a slew of interest rate cut as well. As you know that you look at this light turquoise blue line, it's diagonally going downwards. All right, so implying that there is going to be a potential interest rate cut cycle coming into play. So how do I read this table over here is, if you were to look at the next meeting, which is our 7th of November, pardon me, 7th of November, it will do another 25 basis point cut, but this time around the odds is not so high. It's at 55%, which is slightly above 50, to bring it down to 4.75% to 5%. Then thereafter, it will stamp pat on December. Only a slightly below 50% chance, means only 47% chance that the Fed will do another cut to bring it down to 4.5% to 4.75%. So right now, if you base on the current probability or the odds as being implied by the CME Fed Watch 2, based on the Fed funds interest rate futures contract, market participants are looking at least 2 to 3 cuts before 2024 ends. Then thereafter, ahead of the curve down the road in 2025, we start to see a slew of potential interest rate further cuts coming in the January meeting. Okay, so January meeting, 29 January 2025. So this is next year. 83% chance there will be a 25 basis point cut to bring it down to 4.5. Okay, much more higher than the December odds right now. Then thereafter, in the March meeting, another 25 basis point cut to bring it down to 4.25 to 4.5% on 19th of March 2025. So we start to see the market expectation has starts to change their stance from a Fed that is wanting to keep interest rate higher for a longer period of time, to start thinking or to start implementing a interest rate cut cycle. And definitely these odds could change again when it comes towards the first, the more or less 100% pricing first cut in September. Why? Because during the September meeting, which is on 18th of September this year, the Fed will release its latest dot plot projection. So what is dot plot projection? So dot plot projection tells us the Federal Reserve officials forecast, both in terms of average and median, in terms of inflationary trend, GDP growth, unemployment rate in the US, and as well the expectation of their Fed funds rate level from a near-term, short-term to medium-term perspective. And from there, we could infer how many potential implied interest rate cut or hike that is being inferred in their latest dot plot projection when they release it in September. All right, so we'll talk more about that thereafter. Okay, during the day dose at that point in time. Okay, so with that, now let us share with you one more chart of the intermarket perspective, is this bull steepening. So like I mentioned, this is the bull steepening that we are seeing right now, where the 10-year is at the 2-year is coming down at a faster pace than the 10-year US Treasury yield. So the spread between the 10-year and the 2-year actually steepened upwards, okay, inching back towards the positive territory. Why? Because previously we are showing the yield curve inversion since this where was it? Yeah, since June 2022. Yeah, over here. Okay, came down. Yeah, since June 2022. So that's about 2 years back, the curve inverted. So at that point in time when that was a yield curve inversion, if the yield curve continue to inch downwards lower and lower, that means the inversion get deeper and deeper. So this is where the potential hard landing may come in the US economy. So we talk about recession. But now the curve continues to uninvert and it continue to inch up higher and is able to clear above the resistance at negative 0.8%. It will totally remove the yield curve inversion and starts to steepen much further on the upside as you go into the positive territory over here. All right, so this is what I call the bull steepening that is taking shape. So now the key thing is its impact on the stock market. So what I could see over here is that previously there was a steepening as well that took shape during the So during the pandemic, this is where the Fed and the US government flood the market with stimulus measure, both from consumer related vouchers, spending vouchers, debt relief for students loan, and as well as the Federal Reserve enacting another QE form of QE and cut interest rate to almost 0% again during that period. So from the period of 20th of April 2022 all the way up to April 2021, close to a year, we see the yield curve steepening as well. So once this yield curve steepening, I want to take notice at these two lines over here, the dark blue and the turquoise blue line. So this blue line actually ratio between the Dow Jones Industrial Average divided by the Nasdaq 100, and the turquoise that is a dark blue line, and the turquoise blue line, which is the Russell 2000 divided by the Nasdaq 100, this ratio actually rose as well. Okay, so it came to us that during this period of bull steepening of the yield curve, it actually led to the Russell 2000 and the Dow Jones Industrial Average to outperform the Nasdaq 100, which is heavily weighted in the technology sector. And like I say, the yield curve steepening actually benefits the small cap stocks and the value oriented component stocks that is heavily weighted on the Dow Jones Industrial Average. So basically, it's the banks. All right, the banks is one of them, and some of these cyclical or industrial stocks. Why banks benefit? Because banks net profit margin is based on their net income, net interest income margin. That means they are able to actually, number one, lend out. Because they lend out, the business is lending out and borrow short term. So borrow short term, they are able to borrow at a lower interest cost to them, and they are able to lend out at a higher profit margin because higher interest income by the charge of their loan customer. So it actually benefited the financials of the banks during this stage in time. So right now what we are seeing the same scenario happening as well, and now finally we start to see a tick up over here in the performance of the Dow Jones and the Russell 2000 that is actually playing out right now in terms of their outperformance against the Nasdaq 100. All right, so now continue to monitor this. So once if there's a breakout of negative 0.08%, potentially we could see the performance of the Russell 2000 and the Dow Jones Industrial Average outperforming the Nasdaq 100, which indirectly also outperforming the S&P 500 going forward. Okay, now that actually end the intermarket dynamics for today. All right, I want to share with your distinct interest. This is the key thing that is playing out right now. So with that, now let us now take a look at the short-term intraday technicals. Okay, but before that, let me actually expand my screen so that you guys could have a better visual of it. So let us start with the FX market. So over the FX market, earlier on I flashed this chart. So what we are seeing right now in a very short term, we see a K-shaped performance. That means the dollar is strengthening against the Aussie and the Kiwi, but weakening very steeply against the yen and sideways against the rest, like the dollar Swiss, the dollar sterling, the dollar euro, and the dollar CAD, more like a sideways basis instead. Okay, but during the intraday point of view over here, what's this 5-day? From intraday perspective for today, we got to respect some key levels. If those key levels has been taken out on the various currency, we got to actually consider flipping to the directional bias based on the current price action on the intraday perspective. So what do I mean by this? If you take a now, let us start with the euro dollar. All right, so the euro dollar over here, okay, yesterday we attempt to actually have a bullish bias. Why? Because the price action is still trading at and above the minor ascending channel support level that I drew from the low of 26th of June. So that was the pivotal support here around this 0.870. But however, yesterday the price action clearly broken down below this level. All right, very clearly. So it break down the lower limit of this minor ascending channel, And with that, over here, it actually implies to us that is this downside momentum coming into play for the euro dollar on a at least on the intraday basis. So with that, we got to respect the price action, which is more skewing towards the bearish side of the story rather than the bullish narrative right now. So we will flip to a intraday bearish bias on the euro dollar using the 1.0880, 1.0880 as my short-term pivotal resistance. A breakdown below this support level that is being tested right now at 1.0840 may expose the next near-term support at 1.0804. 805, okay, 1.0805 on the intraday basis, which also correspond to the 50-day and the 200-day moving average. A breakdown below 1.0805 will tend to expose the next near-term support level over here. Okay, at 1.077. Okay, let me put it down so that you guys could see 1.0770. Okay, and if you do the Fibo retracement over here, taken from the previous up move from 26th of June all the way up to the high of 17th of July, it corresponds to the golden ratio as well at 61.8%. Okay, only an hourly close and a breakout above 1.0880 will invalidate today's intraday bearish bias to see the recovery taking shape, a minor recovery taking shape for the euro dollar. Next, or a first near-term resistance level to watch will be at 1.0920. Above it exposes 1.0960 slash 1.0980, which is the also the medium-term ascending, a medium-term symmetrical triangle range configuration. This we call it the gray line here that is in place close to a year ago. Okay, so that's for the euro dollar. So very clearly on the sterling dollar, yesterday we were neutral between this 1.29 figure and 1.2990. So as usual, today's it break down below the 1.29 figure level very clearly. 2 hours of hourly close below it, 2 period of hourly close below it. So very likely, if it continues to inch down lower again today and failure to actually go up above 1.29 figure level, it means that the previous push up from 12th of July, that period itself triggered that bullish breakout. So this bullish breakout over here may deem as a failure bullish breakout, very similar of what we've seen on the Australia dollar that has that took shape at the start of this week, that led to this ongoing we call it persistent weakness on the Aussie dollar. So that could be the sterling dollar fate as well. Okay, if today it fails to actually have a daily close back above the 1.29 figure level. So, but on the intraday basis over here, very clearly is it already turned to a bearish bias or a bearish momentum has surfaced on the sterling dollar. So with that, we'll be using yesterday's high level, okay, which was also a near-term resistance since Monday at 1.2940. So 1.2940 will be my short-term pivotal resistance level, slightly above 1.29 figure level. Flip to a short-term intraday bearish bias on the sterling dollar. First near-term support level to watch will be at 1.2845, close to the 20-day moving average. If this level can't hold, it may expose the next near-term support level at 1.2780, which confluence with the 50-day moving average that is acting as a support level as well. Only hourly close and a break up above 1.2940 pivotal resistance for today will invalidate today's intraday bearish bias to see the recovery state reinstating into the sterling dollar. Next near-term resistance level to watch 1.2990, followed by the swing high area of 17th of July at 130.40 slash 130.65. Now, moving on will be the dollar against the Asia Pacific pair, starting with the Australia dollar. So like I mentioned earlier on, the Australia dollar, what causes this ongoing persistent short-term decline was the failure bullish breakout previously on 4th of July, where the price broke above the upper limit of the symmetrical triangle range configuration range resistance that was in place since the of February last year. And the last few days, price action actually reintegrate below this level, and we see a slew of 1, 2, 3, 4 persistent day of decline. Okay, and right now it's coming close to the 200-day moving average that's acting as a support level at 65 over here. Okay, so from a intraday perspective right now, the hourly RSI do not have any signs of a bullish divergence. So there was no bullish divergence. So, okay, so sorry, not this, this is the, okay, over here. My apologies, I clicked too fast. Okay, this is the Australia dollar. Okay, so it goes to came down over here, plunges. So now testing the 65.90 level, which is close to the 200-day moving average. So at this point in time, the hourly RSI, yes, is oversold, but after hitting the oversold level, there's no bullish divergence yet. Yes, there could be a bit of bounce coming into play. So first bounce level to watch, the first near-term support level to near-term resistance level to watch will be at 66.20 level, which was yesterday's US session high. And what I'll do over here is that I will put a slightly higher level at 66.40, 66.40. So 66.40, if you will do the Fibo retracement, okay, taking into account of this down move here, this ongoing down move from 17th of July all the way down to the current intraday low, it corresponds to the 23.6%, right, over here. So in terms of the Elliott wave perspective, we will see a very clear 5-wave down, and after that 5-wave down over here, the 5-wave down may extend as well. So as long as this extension can't clear above, any bounce can't clear above the 23.6% Fibo retracement based on the Elliott wave perspective, that means the impulsive down move sequence could extend much further potentially. All right, so so that's why I leave it around very close to the 23.6% Fibo retracement at 66.40 over here. All right, so using a Titan short-term pivotal resistance level 66.40. So as long as any bounce didn't surpass 66.40 short-term pivotal resistance level, we will maintain that short-term intraday bearish bias that we have from yesterday. After a breakdown below 65.90, which is close to the 200-day moving average, may expose the next near-term support level at 65.60, followed by 65.40. In terms of graphically, these are the support level over here, minor swing low of 8th of May, and the congestion area of 2nd of May. And in terms of the Fibo extension level, we do see a clustering of level also confluencing at 65.60, 64.60. So what I do over, I put it here. Okay, this is 2.618 at 65.40. And we do it from a smaller horizon. Take it from here, push it up to here. This gives us 1.382, and also very close to the 2 times. Okay, 1.618 is at 0.6577, very close to the graphical of 65.60, and 2 times will be at 65.48, very close to the graphical support of 65.40. All right, so these two graphical support levels seems may act as something like a magnetic force, given that it confluences with a bunch of Fibo extension clustering level. All right, let me put it on, yeah, over here. Okay, so with that, only an hourly close above 66.40. That means if the rebound getting much more steeper and break above 66.40, then what we could see over here, we could start to see a form of a mean reversion rebound scenario, exposing the next near-term resistance after 66.40 at 66.70 and even 67 figure slash 67.10, which is the previous symmetrical triangle range resistance right now, and also the 20-day moving average acting as a resistance level as well. And 66.70 is confluencing also with the 50-day moving average acting as a resistance. Okay, so that's for the Aussie dollar. Now moving on will be the dollar yen. So dollar yen tumbled as expected and hit our support level, the second support level at 15510 slash 154.75. So at this moment in time, no bullish divergence, pardon me, that means no higher low. Price action going to see lower low on the RSI, indicating to us that the downside momentum still remain intact, but except the fact that it's at the oversold region right now, potentially there could be a bounce. So today we will have a very tightened short-term pivotal resistance that we have, which also correspond to the upper limit of this minor descending channel that has now taken shape since the high of 11th of July at 156.45, also confluencing with the former minor swing low of 22nd of June. So using a Titan key short-term pivotal resistance for today, 156.45, maintain that short-term intraday bearish bias. A breakdown below 154.75 exposes the next near-term support at 153.90 slash 153.70. okay, which confluence with the minor swing low of 16 of May and the 1.236 Fibo extension level over here. Okay, and if you want to do the clustering level, you put it down from here, check it up to here. Okay, it also correspond to 1 time as well. Only an hourly close above 1.15645 will invalidate today's intraday bearish bias to see a much more deeper counter trend rebound scenario unfolding, minor counter trend rebound scenario unfolding. Next resistance level to watch will be 15770, which correspond to the 50-day moving average that is acting as a resistance level right now, okay, at 15770. Now, let's sum up the intraday technical outlook on the major FX pair. Now, let us focus on the major stock indices, starting from the Asia Pacific Stock Index, the Hang Seng Index, or the Hong Kong 33. So on the Hong Kong 33, yesterday we do have a bearish bias, already hit the support level at 17,320 right now. And the RSI also coming very close to the oversold region. And most importantly, the current price actually is very close to the medium-term pivotal support, which I highlighted earlier as well. Yesterday, 17,200 / 17,110, which is the 200-day moving average. Fibo extension level 0.764 over here. You can see on my screen. And graphically, is this former minor swing low area, former swing high area of 13th of June, 10th of April that was taken out previously, that give rise to this steep rally, all right, until it hit the high of on middle of May at 19,000, at around this 20,000 level, all right, close to it, all right, exactly 19,980, okay, or 19,790, pardon me, okay. So with that, since it's coming very close to the medium-term pivotal support, there could be some form at least of a minor bounce on the intraday basis. So I'll be using the medium-term pivotal support as my key support level for today on the intraday basis, 17,200 / 17,110. Potentially, there could be a bounce taking place. So we will flip to a short-term intraday bullish bias for today on the Hong Kong 33. First resistance level to watch is in fact today's today Asia session high at 17,517. Above it may expose Monday's minor swing high at 17,750, which is also the 20-day moving average, I think, as a resistance level as well. So these are the two resistance level to watch if the bounce able to materialize on the intraday basis for today. Okay, but however, if we start to see a breakdown below 17,110, then today's intraday bullish bias for that minor bounce scenario will be invalidated to see the continuation of this decline. This decline to expose the next near-term support level at 17,030, followed by 16,840, which is a confluence with the one-time Fibo extension taken from the taken down from the recent down move from 12th of June to 17th of June, project to the minor swing high of 18th of July. Then the below 17,030, 16,840 correspond to the 1.26 Fibo extension. And both this level in terms of graphically, we do see a bit of congestion area over here as well, okay, during the April period this year. Okay, so that's for the Hong Kong 33. Moving on will be the Nikkei 225 or the Japan 225. Still no change, going to kind of trade sideways over here between the neutrality range that we have yesterday, 40,050, 39,350 level. Okay, so still maintain that neutrality level between these two range, except that if we start to see an hourly close below 39,350, then this ongoing minor corrective decline that has taken shape since its all-time high on 11th of July may continue its descent to expose the next near-term support level at 38,750. Below it may see the minor swing low of 17th of June coming in again, or at 37,980 level. Okay, so that's for the Japan 225. Okay, now moving on will be the European stock index. One of them will be the German 30 or the German DAX, we call it. So yesterday, the German 30 managed to rally steeply beyond our expectation, because initially we expect a minor dip first. to around 18,290 before rallying. So it actually hit the resistance level that we highlighted, 18,630. So right now the RSI already hit the overbought level yesterday, and it exit from the overbought level. So potentially now we may see a bit of minor pullback taking shape. So we will have a tighten key. And yesterday, I'm not highlight over here is that even though it hit the overbought level, upon hitting the overbought level, there is no bearish divergence. Okay, no bearish divergence. So indicating that potentially it may not see, even though it starts to see exit from the overbought, maybe lower odds of a deeper retracement to retrace fully or almost fully the ongoing rebound that is being seen on 19th of July all the way up to 23rd of July because of the lack of the clear downside momentum because there's no bearish divergence. So with that, I could have a tighter key short-term pivotal support for today for that potential pullback to hold, which is 18,400, which is so close to the 20-day moving average. And if you do the Fibo retracement of this ongoing move or the most recent swing up from last Friday all the way up to yesterday's high is 50%. All right, so as long as the pullback didn't surpass below 18,400, short-term pivotal support, a tighten one that we have for today, we will still maintain the short-term intraday bearish bias on the German 30. First resistance to watch, 18,630, that was yesterday's resistance. Above it, may see a retest of the 12th of July minus swing high area at 18,770. 18,770. Only an hourly close below 18,400 will invalidate today's intraday bullish bias to see a slide all the way down to retest the lower limit of the expanding wedge configuration that's in purple line in place since 14th of June. Support at 18,290 followed by 18,150 after the breakdown of 18,400. Now that's for the German 30. Now with that, let us move on to the major US stock indices, starting with the Dow Jones Industrial Average or the Wall Street 30. So the Wall Street 30 continued to trade sideways yesterday. Yesterday at the start of the, I would say that the US session, it managed to bounce. Then thereafter, it can't surpass the first resistance at 40,670 and it traded back down again. So still no change, still using the 20-day moving average that is acting as a support level, 39,890. So that will be my short-term pivotal support level. So as long as this level holds, we still maintain that short-term intraday bullish bias. First resistance you got to surpass will be at 40,670. Then thereafter, it may expose the next near-term resistance at 41,050 from an intraday basis. However, an hourly close below 39,890 will invalidate this bullish bias on the US Wall Street 30 or the Dow Jones Industrial Average to see the extension of this minor corrective decline to play out to expose the next near-term support at 39,620 followed by 39,300, which correspond to the rising 50-day moving average as well. Now, moving on will be the Nasdaq 100. So the Nasdaq 100 yesterday, it actually continues to hover pretty much healthy, except for today's gap down due to that bearish earnings expectation that doesn't meet the street, which is the Tesla and as well as Alphabet in one of its business segment. Excuse me, which is the YouTube channel. So with that, it still managed to the key pivotal support still no change. It's at the 50-day moving average and also last Friday minus swing low that we preset earlier at 19,520 level. All right, and also right now the price action is reintegrating or retesting the lower limit. Okay, not lower, the medium-term ascending trend line from 19th of April 2024 low. So there's some form of support still holding the Nasdaq 100. So since it can't break below 19,520, we can't flip to a bearish bias yet over here. So with that, still using 19,520 as my short-term pivotal support level. But however, I do have a kind of a trigger level to actually further increase the odds of a bullish bias coming back into the picture will be this gap resistance here. Okay, the gap down that was formed in early today Asia session at 19,780. So if price action in the next few hours managed to actually reintegrate back above 19,780, then the odds will have increased to maintain that short-term intraday bullish bias on the Nasdaq 100 with the first resistance unchanged at 20,060, which is also confluence with the 20-day moving average, and above it may see a retest of their former minor swing low of 12th of July, now acting as a next near-term resistance at 20,210. Only an hourly close or and a breakdown below 19,520 will invalidate today's intraday bullish bias, pardon me. I repeat again, a bit of tongue twisting. If we start to see a breakdown below 19,520, then it will invalidate today's intraday bullish bias to see the extension of the minor corrective decline to expose the next near-term supports level of 19,115 and 18,950 next. All right, so these are this graphical congestion area over here from 7th of June to 11th of June. Now, that sum up the short-term intraday technical outlook for the major stock indices. Now, let us move on to the commodities market, starting with gold XAU/USD. So gold, no change, continues to be resilient above the 20-day moving average from the bullish side of the story, and also bouncing above the excess that we have yesterday, 2,383 short-term pivotal support that we have, and the RSI continue to shape a series of higher low and now trading above the 50 level mark and still hasn't hit the overbought region yet itself. So over here, still no change. So this level here, okay, so this level will be my first support level to watch for today, given it has really broken out today in today's Asia session at 2,408. So, but I don't put it so tight, 2,408 as my short-term pivotal support. So this is something like a first support level to watch. Pivotal support still remains the same as this zone here, 2,393/2,383. So as long as this pivotal support zone holds for today, we will maintain that ongoing short-term intraday bullish bias on gold XAU/USD. Next near-term resistance level to watch in the first step, 2,431, followed by 2,452 on the intraday basis. Only an hourly close below 2,383 will invalidate today's intraday bullish bias on gold XAU/USD to see the extension of this corrective decline to expose the next supports level at 2,368, which close to the 50-day moving average. Failure to hold above this level will put the medium-term uptrend in jeopardy to see a further extension of the corrective decline in first step to expose the next near-term support level at 2,337. Okay, so that's for gold XAU/USD. Now, moving on will be the West Texas crude oil. So West Texas crude oil continues to remain weak. So yesterday we do expect a bounce off from the 200-day moving average. Yes, it managed to stage a bounce, but this bounce only lasts during the European session. Didn't hit the first resistance that we highlight at $80.30, which is 80.30 per barrel, which is also right below the 50-day moving average before plunging down, all right, and broke below the 200-day moving average, which is our pivotal support level yesterday. And given that the RSI, there's no bullish divergence on the RSI that's been formed yesterday, this ongoing short-term minor downtrend phase that is in place since the rejection of this minor descending trend line from the 5th of July high, it still remains intact. And with the breakdown of the 200-day moving average, it may continue to translate into a further negative feedback loop, at least in the short-term intraday basis for West Texas oil. So with that, we will have a bearish bias for today on the intraday basis using 78.95 as my short-term pivotal resistance level. A breakdown below yesterday's minor swing low, which is close to 77.80. So this is the level. Let me put it, highlight it the better level. Okay, this level here, 77.60. So a breakdown below 77.60 exposes the next near-term support level at 76.30 and even 75.46 level over here, which is the congestion area of 7th of June and 10th of June, which you could see at this point in time. Okay, this region here. And also, if you were to do the Fibo extension taken from the high of 5th of July, project it down to the low of 16th of June, extend it further up towards the minor swing high of the rejection over here, it corresponds, this one, the 76.3 correspond to the closely to the 1.68 level. Okay, but however, if we start to see an hourly close, that means reintegration back above the 200-day moving average, which is the 78.95 short-term pivotal resistance that we have for today, it will invalidate today's intraday bearish bias to see the start of a counter trend rebound scenario unfolding. Next resistance level to watch, 80.30 followed by 81.20 on the West Texas crude oil. Okay, so with that, that sum up the short-term intraday technical outlook for oil and as well as the major cross-asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for? So like I mentioned, today will be the release of global flash PMI data, both from the manufacturing and the services perspective across different regions. So at the start of the European session, or before the start of the European session at 2 p.m. Singapore time, we do have a slew of key Eurozone GDP data that has been released as well. No, key Eurozone PMI flash data that's being released. So before that, at 2 p.m., we have the Germany Consumer Confidence Index for the month of August. Then thereafter, at 3:30 p.m. Singapore time, we see Germany, France, as well as the Eurozone, all of them releasing the flash manufacturing and the services PMI data. And 1 hour later at 4:30 p.m., we see the release of UK flash manufacturing PMI and services data for July. And closer into the US session at 8 p.m., we do have one ECB official speaking, ECB Lane official speaking at 8 p.m. Singapore time. And thereafter, we do have those who are looking at the Canada currency or any pair that's related to the Canada dollar. We do have Bank of Canada interest rate decision at 9:45 p.m. Singapore time. And at the same time, we also have the release of the US manufacturing PMI and services PMI, both on a preliminary finding, which is the flash, which these are the preliminary data for the month of July at 9:45 p.m. And thereafter, we do have at 10:30 p.m. we have the BOC Governor Press Conference. Okay, then thereafter, we do have that weekly crude oil stockpile change for the week ending last Friday, 19th of July at 10:30 p.m. Singapore time. All right, so that actually sum up today's key economic data to look out for, and as well as also today's daily dose of market insights. So with that, I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.